Congress just quietly handed retirees a $6,000 tax gift, and almost nobody is talking about it. If you are 65 or older, or if you are planning your retirement around the next few years, this deduction could fundamentally change how much tax you pay, how aggressively you convert to a Roth IRA, and how you avoid some of the most expensive Medicare surcharges in the system. But there is a hard deadline attached to it, and when it expires, this window closes permanently. This video breaks down exactly what this deduction is, how it works inside your overall tax picture, and the specific strategy that makes the most of it before 2028. This is a general educational breakdown, and the exact tax impact depends heavily on your individual situation. What the One Big Beautiful Bill Act actually did. In 2025, Congress passed the One Big Beautiful Bill Act, a sweeping legislative package that included, among other provisions, a brand new temporary tax deduction specifically designed for seniors. Under this provision, Americans age 65 and older can claim an additional $6,000 deduction on their federal income tax return. For married couples where both spouses are 65 or older, that deduction doubles to $12,000. This is a deduction, not a credit. That distinction matters and is worth understanding clearly. A tax credit reduces your tax bill dollar for dollar. A tax deduction reduces the amount of income that gets taxed. At a 22% federal tax bracket, a $6,000 deduction reduces your actual tax bill by $1,320. At the 24% bracket, the same deduction saves you $1,440. It is meaningful but operates differently than a direct credit. The deduction is set to expire after the 2028 tax year. That gives eligible seniors a 4-year window from 2025 through 2028 to use it strategically. What that window enables, particularly when layered with Roth conversion planning, is the real story here. Why this deduction creates a rare Roth conversion opportunity. To understand why this matters so much, you need to understand the core challenge every traditional IRA and 401k holder faces in retirement: required minimum distributions. Once you turn 73, the IRS requires you to begin taking minimum withdrawals from your traditional pre-tax retirement accounts every year. The amount is calculated based on your account balance and your life expectancy factor as defined in IRS publication 590-B. You cannot skip it, defer it, or shrink it. And every dollar you withdraw is taxed as ordinary income. The problem is that for many retirees who saved diligently in pre-tax accounts for decades, those RMDs push them into unexpectedly high tax brackets. Some retirees with $800,000 to $2 million in traditional IRA or 401k assets find that their RMDs alone generate $50,000 to $80,000 per year in forced taxable income before they spend a single dollar from any other source. This is where Roth conversions become one of the most powerful retirement tax strategies available, and where the new $6,000 deduction creates a genuinely strategic opening. A Roth conversion involves taking money from a traditional pre-tax IRA or 401k and moving it into a Roth IRA. You pay income tax on the converted amount in the year of conversion. But once that money is inside the Roth, it grows completely tax-free and, critically, is never subject to required minimum distributions during your lifetime. Any withdrawals from the Roth in retirement are also completely tax-free. The reason the $6,000 senior deduction amplifies this opportunity is straightforward. If you are 65 or older and file individually, you now have an additional $6,000 of income space that is effectively tax-sheltered. That means you can convert $6,000 more from a traditional IRA to a Roth IRA this year, compared to prior years, staying within the same tax bracket, without that conversion income pushing you into a higher rate. For a couple, that is $12,000 of additional Roth conversion capacity at the same bracket level. Repeated over 4 years from 2025 to 2028, a couple could convert up to $48,000 in additional pre-tax IRA assets into a Roth completely within their existing bracket structure, reducing future RMDs and their associated tax burden permanently. Understanding IRMAA and why it changes the calculus. There is a second dimension to this strategy that makes it even more relevant for retirees with substantial savings. IRMAA, which stands for Income-Related Monthly Adjustment Amount. IRMAA is a Medicare surcharge applied to your Part B and Part D premiums when your modified adjusted gross income exceeds certain thresholds. In 2026, the base Medicare Part B premium is $185 per month. But if your Magi exceeds $106,000 as an individual or $212,000 as a married couple, your monthly Part B premium increases. At higher income levels, the surcharge can push your total Part B premium to $628.90 per month per person. That is $7,546.80 per year per person, or over $15,000 per year for a couple, just in additional Medicare premium costs. IRMAA is calculated using your income from 2 years prior, so your 2026 Medicare premiums are based on your 2024 tax return. Your 2027 premiums are based on your 2025 return. This 2-year look-back means every income decision you make today ripples forward into your Medicare costs. The senior deduction directly helps manage this exposure. By lowering your modified adjusted gross income through the $6,000 or $12,000 deduction, you create additional buffer room before hitting IRMAA thresholds. This matters enormously for retirees who are hovering near those cutoff points. Crossing an IRMAA tier by even $1 of income can trigger hundreds of dollars in additional Medicare surcharges. The deduction creates breathing room to stay under those lines while still executing meaningful Roth conversions. If this is genuinely reshaping how you think about your retirement tax strategy, hit that like button right now. This kind of detailed planning content takes time to research properly, and your engagement is what makes it possible to keep producing it. A real-world example to tie it together. Consider a 67-year-old retiree filing individually with $900,000 in a traditional IRA, Social Security income of $24,000 per year, and modest additional income from a part-time consulting arrangement totaling $15,000 per year. Total gross income before any deductions, $39,000 per year. After the standard deduction of $15,000 for a single filer, age 65 or older in 2026, which itself includes the existing additional standard deduction for seniors, and the new $6,000 OBBBA deduction, taxable income is reduced meaningfully. This individual can now perform a Roth conversion of an additional $6,000 per year without moving up a bracket or triggering an IRMAA adjustment, compared to what they could have converted before this legislation passed. Multiply that by 4 years, and they have shifted $24,000 from a fully taxable traditional IRA into a permanently tax-free Roth IRA at no additional tax cost. At age 73, when RMDs begin, their required minimum distributions will be calculated against a smaller pre-tax account balance. Their taxable income in those later years drops. Their Medicare premiums may be lower. Their heirs will receive a larger tax-free inheritance. That is the real value of this deduction when used with intention. How to think about this strategically? The 4 steps that matter most in this window are as follows. First, verify your eligibility. The deduction applies to taxpayers age 65 or older for the applicable tax year. Consult with a CPA or enrolled agent to confirm how it interacts with your specific income sources, deductions, and filing status for 2025 through 2028. Second, model your current Roth conversion capacity. Your financial planner or tax advisor can project exactly how much you can convert each year while staying within your current bracket and below your relevant IRMAA tier. The new $6,000 deduction changes that calculation and should be factored into any plan that was built before this legislation passed. Third, begin conversions in 2025 if you have not already. The clock is running. Each year you wait is one fewer year of the deduction available to you. Spreading conversions across all 4 years of the window is generally more tax efficient than front-loading or back-loading the conversions into fewer years. Fourth, review your overall income picture in October and November of each year before the tax year closes. Roth conversions can be executed at any point during the calendar year, including the final weeks of December. A year-end income review lets you see exactly how much conversion room you have remaining before crossing into a higher bracket or an IRMAA surcharge tier. This deduction expires after 2028. Legislation can change, but there is no current indication of an extension. The window is real, the math is favorable, and the planning opportunity is available to every eligible retiree right now. The retirees who use this window thoughtfully will emerge on the other side with smaller RMD burdens, lower Medicare premiums, larger tax-free Roth balances, and more flexibility in how they draw income in their later years. That is not a small outcome. It is a structural improvement to the entire back half of their financial life. If this video changed how you are thinking about your tax strategy in retirement, subscribe to this channel now. Every week covers exactly this kind of precise, actionable financial content for people who are serious about protecting and growing what they have built. One click on subscribe, and you will not miss what comes next.